Looking at the sector rotation, we're seeing a fair amount of rotation here right now, a good amount of rotation, which is healthy for the market rally here. You have consumer discretionary, trading back to new all-time highs while it outperforms the S&P 500. Definitely one of the leading sectors that are continuing to push the markets higher here. You also have financials breaking out to new all-time highs while outperforming the S&P 500. These are two of the strongest sectors here right now in the markets. You have industrials kind of close behind here, not quite outperforming the S&P 500. It's outperforming by a small margin, but industrials also printing that new 52-week high and outperforming the S&P 500. And communications, also same thing, continuing to print new all-time highs as it outperforms the S&P 500 over the past couple of weeks. And then on the flip side, from industrials, you have materials kind of struggling a little bit here, failing to make new highs, actually on the opposite, making new lows. And as you can see, materials underperforming the S&P 500, which is interesting because usually materials and industrials move together. We're seeing that kind of bifurcate a little bit here right now. Energy shares, this is what I was referring to, kind of reaching this sort of double top here. So losing some ground here as it was sort of outperforming a little bit, but starting to underperform, especially with energy shares or oil prices creating a bit of a drag here on oil stocks, that rallied on the back of the Trump victory. But at the moment, with oil prices at 52-week lows, providing a little bit of drag here on the energy sector overall. You also have utilities seemingly breaking out to new all-time highs, which would certainly be traditionally looked at as a relatively positive for the sector. But note that, it's actually continuing to underperform as it makes new highs. So this is one that's falling behind here a little bit here. So a little bit of rotation out of utilities that has been a very strong sector almost throughout this entire year, outperforming the S&P 500. But we're starting to see some early signs of utilities starting to underperform the S&P 500. You also have the same thing with home builders. Home builders relatively strong here on the back of the decline we've seen in interest rates over the past couple of weeks. But as you can see, it's coming against this major resistance level that's struggled with a little bit over the past. And as you can see, as it kind of reclaims those recent highs, it's actually underperforming the S&P 500, which leads me to believe that there's more range-bound price action ahead rather than a breakout from here. So for those of you that are looking at those home builders and looking for opportunities, be a little bit cautious here because I do think that the underperformance here is a little concerning as it gets back to those recent highs. And then semiconductors continues to underperform. So as the equity markets reach new all-time highs, semiconductors are reaching new relative lows, underperforming the S&P 500 by a pretty significant margin here over the past 4 or 5 months. So this is something to definitely be concerned about, and depending on whether how much exposure you have to this particular sector, making sure that you sort of make the right adjustments as to whether you continue to hold on to specific semiconductor names in your portfolio as it continues to underperform the S&P 500. And then looking at our research ideas. So this is really kind of going to be a more central focus of these sessions going forward on Monday mornings, is to walk you through the key research ideas that we have open here at the moment. As you can see, we have quite a few open ideas today. We added two of them, Dexcom and Costar Group. I'll walk you through both of those and then also at the same time walk you through all of our existing open trades. First one I want to take a look at here is NVIDIA. So this is one that we started to put together post the last earnings. Effectively, what we're looking at is kind of this breakout here and retest of this 130, call it 132, 133 of that support level here, of that breakout here, and looking for a continuation higher from a risk reward perspective. Technically, that looks fairly attractive. And then fundamentally, it also looks quite attractive here as well, because even though NVIDIA looks like it's trading at a pretty significant premium relative to the industry, if you look at the growth metrics, if you look at the profitability metrics, we're talking about numbers that are head and shoulders above its peers. We're talking about EPS growth that's nearly 5 times faster than the industry, revenue growth that's nearly 8 times faster than the industry, and then profitability, we're talking about more than double the profitability of its sector or its industry, which is already on the high end. So for those reasons, I think NVIDIA deserves to trade at a premium. And, the fact that it trades at the moment about a little over 50% premium to the industry actually still reflects a pretty significant discount, in my opinion, given how fast it grows and how profitable it is. And for those reasons, I think that there's still plenty of upside left here for NVIDIA for those that are long-term investors. And the recent pause and the consolidation provides a much better entry for further upside if you don't already have some NVIDIA exposure in your portfolio. Next one I want to take a look at here is Disney. We brought up Disney when it was still kind of completing this bottoming formation. It's since then gapped higher here, gapped higher on earnings, and our upside target here is around 125 now, which is kind of those recent highs that we pushed back here in April of this year. That's our upside target. As you can see, it's currently trading at slightly higher than industry averages, but it is more profitable. It is expected to grow revenues faster than the industry. So for those reasons, I think 125 is still a reasonable upside here to reach as Disney has kind of focused on its turnaround story. They've been able to, grow top and bottom line fairly significantly, turn around of the Disney Plus business, back into profitability by the end of this year, beginning of next year. And, we've seen theme parks continue to be fairly resilient in terms of revenue. So for those reasons, I think Disney is very much on its way back towards, those 125 targets. Once we reach 125, this is likely the type of stock that we'll likely remove from our research report after it hits our final target price. Now, Shopify, we've also had in our portfolio for quite some time here as well. Well, we kind of highlighted this when it was kind of completing this bottoming formation, and we caught it here around that $80 level here. It's trading at around 115 now. Our upside target here is around 140. This is currently trading at about 50% higher valuation relative to its peers, but look at the growth metrics. We're talking about head and shoulders above its peers. It is equally as profitable, but growing significantly faster than its group. And for those reasons, it deserves to trade at a premium valuation here, as it does right now. Now, Costar Group, this is one that we are just adding here to our research today. Costar Group, as you can see, similar to Disney and Shopify and some of the other names that we've kind of looked at, looks like it's recently completing a bottoming formation. So, below $80, it's been trading in this range for quite some time and just recently broke out above that range. And with that, it sort of outperformed the S&P 500. So our view is that this can continue to move higher here into the low 90s here for Costar Group. Now, Costar Group is a primary provider of commercial real estate tools, but they also own a lot of marquee brands like apartments.com that offer real estate services for more residential and for more residential purposes, but Costar Group predominantly providing data for commercial real estate. And we've seen the real estate market really have some struggles to get back on its feet over the past couple of years. And as we've seen interest rates decline here a little bit over the past couple of weeks, that's provided a little breathing room here for Costar Group. So this is one that could very much be in the early days of a big run here to the upside, and that's why we're adding Costar Group to our list. It trades at a premium relative to its peers, but as you can see, it's expected to grow significantly faster than its peers. It is more profitable than its peers. So for those reasons, the valuations, while on the surface looking fairly scary, I think is fairly supported by the expected growth metrics that we see for Costar Group.